Well, welcome back to our channel. One of the things I wanted to focus on today is, as you guys know, that our focus is what we call the economic termites. These are the five economic situations that eat away at your wealth. And so we're going to talk about two of them. So what are the five first? Taxes, inflation, time, laws and regulations, and then debt. Okay. And we wrote a book. I wrote a book called Economic Termites, talking about the first four. Debt is not included into it, just due to the breadth of information that would require its own book and its own analysis. So let's talk about in today's channel. And I've done a few different videos on inflation and taxes and laws and regulations, right? The economic termites. So today I want to focus on inflation. And we're going to spin into the inflation of talking about Chairman Powell's last conversation on March 21st, and then how he's talking about raising rates and how inflation is much higher than he expected and all this fun stuff. So I want to kind of let's speak through the BS, if I can be pretty blunt. Let's speak through that. And let's look at the reality of things, and let's look at numbers. And you can't tell me that he did not know and the administration doesn't know, because the reality is that this is your job to know. You are the chairman of the Federal Reserve. You're in control of the supply of dollars and cents in and out of the economy. So let's take a look at this and let's go through. And so if this video is a little bit longer, I apologize, because I want to make sure we address this information, go through this, and look at the consequences to the actions, right? There's consequences. And a lot of times when we say consequences, we refer to negative consequences. There are always positive consequences, right? There's a balancing of the universe, so to speak. There's good and bad consequences for decisions. Well, and here are those consequences. And the reality is that let's just go through this and let's talk about it. So I'm going to minimize my screen. We're going to dive into this article, and I'm going to, not only am I going to dive into this article, I'm going to go in and look at other things to help with this conversation, to kind of weed through this. Now, before we begin, let's talk about this. We're not giving financial advice, tax advice, or anything like that. This is for educational purposes only, and our goal is to again get to the reality of what's being said. And as a small business owner, what are your options? What can you do to help fight and combat what's happening out there? And sometimes, as a business owner myself, I feel like my hands are just tied. There's not a lot I can do. But that's incorrect. There's a lot we can do as business owners. In fact, the administration, the way the rules are working, actually go to our advantage, as long as we know how those rules are played and how to understand them and read them. So let's go ahead and minimize my screen here, and let's dive into this a little bit better. Okay, so Powell says inflation is much too high, and the Fed will take necessary steps to address. Hey, thank you very much. Previously, a year ago, he was saying it's transitory, right? They made up this term to say, oh, this is just temporary. This is because of the pandemic. Well, guess what? And now when you look at a lot of banking and investment experts, they're actually saying our inflation's a lot higher than what they're reporting. And I'd have to agree with that. And I'd have to agree with it's going to stay that way. But let's dive into here and talk about this. So we're the key points, and you can find this article attached to the video, so you can go through this on your own. So I'm not going to go word for word, but he talks about tough action. Well, you're a little bit too late to the game, my friend, and we'll talk about that. He's going to hike rates on interest rates, meaning that's what he's saying, increase the interest rates. That makes money more expensive as it goes into the economy, which traditionally pulls back investment and money into the economy and slows things down. It's one of the tools. Okay, so Federal Reserve Powell on Monday. Now, tough action on the inflation, and he said, which he said jeopardizes an otherwise strong economic recovery. Not necessarily, but okay, let's stick to that narrative. The labor market is very strong and inflation is much too high. The central bank leader said, well, we've talked about the whole labor market as being strong and inflation, all this fun stuff. Before this pandemic, so to speak, the economy was full board, right? We had no inflation. It was low inflation. We had record employment. We had record growth. Every aspect, when you looked at all the different nationalities, you looked at all the different genders, you looked at all the different cultures, you looked at all the different key indicators, and we were almost fully employed is what they look like. There's always going to be some kind of unemployment. Okay? Things were going well. And now all of a sudden this quote unquote pandemic pops up, and now where are we at? Well, let's look at the decisions and nobody is hiding behind this. So this is not saying, oh, Biden did this. No, Trump approved some of these dollars as well. And which I personally think, and this all goes back to 2008 with quantitative easing and not allowing the economy to hit the bottom it should have. The Federal Reserve, they did too big to fail type structure, and yeah, there could have been some consequences to allowing some of these banks to fail, and they picked and chose which would. Right, Lehman Brothers is gone. Bear Stearns is gone. Right, you can go through a kind of a list of some of these banks and investment companies, insurance companies that are no longer in business because of this. Too big to fail. But at the end of the day, the government struck deals with various entities, and we moved on. They allowed the economy to go. They put money into the economy, and all of a sudden, 10 years later, 2008 to 2018, the economy's strong and running forward and doing its thing, right? So now pandemic happens, and what do we have? We have dollars and cents that are essentially, when you have businesses that are told that you're not allowed to do business, right? What happens? Well, of course, there's no revenue. There's no tax revenue there. What's interesting, though, a lot of the blue states have now tax, what's the term? Not deficits, but surpluses. Thank you. They have tax surpluses. How in the world can you as a state have a tax surplus in a period of time where you told people not to go to work, where you told people we couldn't buy, we had to stay in our houses, and right, so we bought stuff online and all that fun stuff, but people didn't drive like they normally did. They didn't go on vacations. They couldn't, and so all of a sudden now you have some of these states at a tax surplus when they were at tax deficit beforehand. That, to me, that's curious, right? I want to question things when that occurs. So let's kind of continue to go through here. He reiterated position of the Federal Open Market Committee. They made it on Wednesday, the post-meeting. Powell said interest rate hikes will continue until inflation is under control. Well, why is he saying that? Well, because they raised rates for the first time in 3 years to battle inflation, which is running at a 40-year high. So what happened in the last 3 years? Well, government spending increased. How do we know that? We'll talk about the $10 trillion that they put into the economy within the last 2 years. That's never happened. We've never had $10 trillion go into the economy. But okay, so that couldn't have been. That's a transitory. That's what he was referring to. That's just temporary. It's well, the money's in the economy. How are you going to pull it out? So we'll take necessary steps. We will take necessary steps to ensure a return to price stability. Okay, thank you. I feel great. And the first thing they're going to do is they're going to raise fund rates by 25 basis points. What's 25 basis points? 0.25%. Okay. Now what's that do? Well, that makes borrowing money more expensive, right? So your credit card interest is going to be higher. Well, guess what? Most credit card companies already have the majority of their people at double-digit interest rates. So, that means, your bank savings can go up by 0.25%. Probably not, right? Your mortgage costs will go up. Yes, that'll go up, but not your savings. And so you don't see an increase in your percentage in savings until there's a significant basis points increase. Usually it's about 0.75 to 1%. And it doesn't usually happen for about 6 months to a year after that raise. So what's that mean for people now? Well, all that really means is that there's going to be sudden price tightening. that comes with inflation as a measured consumer price index. So running at 7.9% on a 12-month basis. Okay, so what's that mean? Well, the central banks got a 2% target. 2% target, what's that mean? Well, let's go to what we call the rule of 72. So let's talk about inflation first, okay? And then we'll go into the rule of 72 and talk about money supply and all that fun stuff. So let's talk about what is inflation. Well, inflation is the decline of purchasing power of a given currency over time. Okay, yes, we know that. Okay, well, how's that happen? Well, because when you go down to here, and as a currency loses value, purchasing power, prices rise and it buys fewer goods and services. Okay, so that means you have to have more money to buy the same goods. This loss of purchasing power impacts the general cost of living for the common public, which ultimately leads to a deceleration in economic growth. The consensus view among economists is that sustained inflation occurs when a nation's money supply growth outpaces economic growth. So what did Powell say in the very beginning? Well, let's go back to his comments. The labor market is very strong and inflation is much too high. We got a strong economy recovery. Okay, those are the terminologies that he used. But when you go back to this, you basically say, okay, money supply outpaced economic. So our economic growth is great, is what Powell's saying. It's good, it's strong, right? Well, what's money supply mean? Well, let's go to the money supply. Well, money supply is all the currency and other liquid instruments in a country's economy on the date measured. Okay, the money supply, blah, blah, blah. Okay, government issue paper, currency, and coin through some combination of a central bank and treasury. Okay, what that means is that they are putting money into the economy. That's what money supply is, right? So understanding money. Economists analyze money supply and develop policies revolving around it through controlling interest rates and increasing or decreasing the amount of money flow in the economy. Okay, increasing or decreasing, right? And then interest rates, okay? Now, the public and private sector analysis perform because the money supply possible impact the price levels, meaning inflation, okay? All right, well, let's talk about that. Let's go back here and let's talk about Powell's interview, okay? So now let's go down here. We were just talked about 7.9. Well, let's fast forward a couple paragraphs. While those aggravating factors have persisted, okay, well, look what's going on. The Fed and Congress provided more than $10 trillion in fiscal and monetary stimulus since the pandemic's start. So March 2020 to March 2022, that's 2 years. $10 trillion in a 2-year span. What's a 25 basis point gonna do? You saw this money going into the economy, and this is not including the quantitative easing from 2008. So 2008, when the Fed started doing quantitative easing, which is controlling the money supply, to now 10 years later, 2018, economy strong, it's great. You go 2 years later to March 2020, which is going into election year, and all of a sudden we have this massive pandemic worldwide. Everybody needs to hide, and we're going to put all this money into the economy. Okay? But you said things are strong and recovering, then why are we adding more money to the economy? $10 trillion. Okay? That's a significant amount. So let's talk about what that means to you and I. So what we want to do is look at the rule of 72. The rule of 72 is basically a simple formula that calculates how long it takes for an investment to double in value based on its rate of return. Well, the opposite is true. Okay? If you have any type of interest rate, okay, then what that means is that the doubling effects is as well. So, for example, if you're paying interest on your mortgage or you're paying interest on credit cards, or how about inflation? It's an interest rate, okay? So we take the number 72 and we divide the interest rate into that 72. And then it gives us how many years of the doubling, okay? So let's go ahead and take a look at this from a numbers perspective. Oops, that's not it here. Okay, rule of 72. So the goal, Fed goal, they said is 2%. So that means in 36 years, your dollar, okay, so let's go over here. Your dollar, is now worth what? 50 cents, right? So what that means is that it takes your dollar decreases in value to 50 cents, doubled or decreased in half. Okay. Now, if we were to increase the inflation just by 2 more percentage, so that means 18 years. So what's that mean in 2022? Well, in 18 years, it would be 2024. Our dollar would now be worth, in 18 years, 50 cents. Well, how about at 6%? Well, in 12 years, or 2034, our dollar will be worth 50 cents. Okay, so that means in order to have the same spending power, don't you have to have the same income to replace that cost? Typically, that's what people would say, right? Is that we need our income to match our cost of living, right? Even if they're not parallel lines, even if they're not parallel, what if they're matched up? Okay, but if you have more debt than income, what's going to happen? You're going to be broke, right? You're going to be swimming in debt and interest rates, all this kinds of stuff. So let's say at the same pathway, you have your income and you have your inflation, your expenses match up. You break even at 0 every month, okay? So what do you people mostly need to do? They usually go get another job, change employers to increase their income, to create that gap, right? Well, what happens when your income increases to pay for these expenses that increases because of inflation? You need more money, so you need to double your dollars, right? So what happens with that? Well, it becomes income, doesn't it? So what's income? It's taxed, isn't it? So when we look at, we're at 7.98%. So in 9 years, 2031, your income, now this is assuming that inflation stays at 8% for the next 9 years. Well, there's a lot of people saying that we're actually at 10% right now. And it should probably stay around that for the next 15 years because of the $10 trillion, because of the spending of the government. The problem with the money supply into the economy is it's supposed to stimulate growth. The problem with that is that it didn't stimulate growth. It actually created more spending by the government, which doesn't create growth. It creates a bigger hole, right? So I'm not speaking out of turn at any of that. So let's look at tax rates then. So if your tax rates, let's say you're at an 89, let's get, let me see if I can get my writing tool here. Okay, so let's say you're at $89,000 in income. Okay, oh, that's single filer. Let's go to the let's go right here. So joint filing. Let's say you're making 178, right at the end of the 22% tax bracket. Okay, so what's that look like? Well, that essentially says that in 10 years, right, if we looked at the inflation numbers, that I would essentially have to have that doubled, right? So what's that look like? Well, 178 times 2 equals 356. Well, where's that at? That's right now in the 32% tax bracket. That's right in here. Okay, so what happened to my taxes? They went up 10%. Okay, that's assuming these tax brackets and these incomes stay exactly the same as they are now. Well, do you think they will? With $10 trillion entering the economy, do you think that the reality is that we're going to stay at the same tax rates? Taxes have to go up. They have to. Either that or they eliminate our current currency and we completely overhaul the currency, which there is speakings and whisperings in the halls of doing just that, called the Great Reset. Okay, now what occurs with that? Well, guess what? All of this does not matter at that point. But the reality is that if we just took all of that scary news out of the equation, we just looked at the very basics of what I'm talking about here. What does this mean for you? Well, that means within 10 years, your income has to double if your purchasing power reduces by double, right? By 100%. So when we say inflation is a taxation, this is what we're referring to. Inflation causes or requires your income to increase. It requires it because why? Your spending habits. You need money to pay for gas, food. Now, we can make the argument that housing prices are higher than the 7.9 inflation. Colleges, gas, food, depending on the type of food you buy. You go get a hamburger now. Your hamburger is either the same price, but you get less meat, right? You go get cereal. What is it? Same box size and less cereal. Same price. That's part of the inflation. Okay? Bags of chips. So what do? Well, they can raise rates, which some people have. And so what's the cost of a burger now? It's no longer $4, it's $8. Well, that's a 100% increase. That's not 7.9. Right? Oh, but it's only $4. No, it's not just $4. You got to add that to everything else you're spending. I don't need to teach you about how to spend money. What I'm doing though is helping you understand that inflation right now is a detriment to our taxation. So what are the 5 economic termites? Taxes, inflation, the time, which we talked about, using the rule of 72, right? And laws and regulations. These laws and regulations, our lawmakers, are what affected the first 3, right? And your debt becomes more expensive. Why? Because now they're increasing the interest rates. So how do you manage your debt and understand the usage of debt as a tool to help you rather than hurt you? Okay? And so what you need is to understand how in those areas to utilize those rules to your advantage. How do you use taxation to your advantage? Well, you need to look at tax planning. You need to look at ways to reduce your tax liability, get closer to your fair share. That will help you understand the recovery and offset some of the inflation. What kind of assets are you supposed to invest in? Do you go put your money into the stock market? Well, are you comfortable with the risk? Because if we do go into recession, typically that causes the markets to go down. And have we seen that? We've seen a lot of volatility. So people usually aren't understanding that with their retirement money, what that means until there's a big dip, right? So, okay, so fine. All right, we understand that. Well, what other assets are out there? Well, the cost of real estate. If your interest rates are going to be higher, the cost of that is going to be higher. So purchasing real estate is going to be affected. What other assets are out there, right? So you need to understand the types of assets where the IRS says, hey, these are the most tax efficient. Utilize these assets. And what we do is we want to help you to use those assets to create a combined plan so they work together, not separately like a lot of times current advisors and professionals talk about and focus on, right? So we want to look at the IRS's guidelines of how they help you understand the taxes and the inflation, which is a taxation, how their laws and regulations, how their control, you can get your time back, okay? So that's the key here is that, yes, inflation. Powell, you're full of it, okay? You were scared to make a decision or somebody was telling you not to make a decision. But at the end of the day, $10 trillion, if you did not know putting $10 trillion in the economy would cause inflation, you should be fired. Because that's the basic definition of inflation. And as an economist, you know that. You know that. So please do not believe this BS that you're hearing out there. We're going to take tough action by taking 0.25% rate increase. Okay. So the 1.9 million in the CARES Act under Trump, and then the other 8.1% or 8.1 trillion after his administration, flooding the market, $10 trillion in 2 years is ridiculous. Absolutely ridiculous. So I can keep going on. I won't, But hopefully this was helpful. Give us a thumbs up if this content was helpful. If you want to know more, add some comments in the comment section. Ask some questions. Put some comments in there. Let us know what you're looking for if you want some more clarification. If you'd like us to do a longer video or a series of videos that talk about this kind of stuff and how to combat it, what's that look like? How based on what I was saying, how do you use taxes to help manage your inflation? And what is my fair share in tax? All those fun questions. Add those down below. Let us help you out. And then if you haven't subscribed, hit the subscribe button and hit the little gray bell so as we add more videos, you get notified as well. Again, down in the description, you're going to get the link to the article so you can take a look at his article. We'll also include the web domains, the URLs of what we were showing in this video. So thanks so much for your time, and we'll chat with you soon. And my name is Robert Wolf with Terra Firma Business and Financial Consultants. I'm an asset coach and a tax strategist.